What if every superpower in the last 500 years collapsed in the exact same way, not by invasion, but by economics? In this powerful breakdown of the 7-stage empire collapse pattern, we expose the hidden sequence that brought down the Spanish Empire, the British Empire, and the Soviet Union, and why the warning signs repeat with mathematical precision. From military overextension and currency debasement to debt spirals, industrial decline, and reserve currency loss, this deep economic analysis reveals how empires actually fall. If you care about global power shifts, economic collapse, inflation, sovereign debt crises, and the future of superpowers, this is a must-watch. Subscribe now and discover how history, as most dominant nations, went from unstoppable to irrelevant, step by step, stage by stage. There is a 7-stage pattern that has quietly dismantled every major superpower of the last 500 years. Not through dramatic invasions, not through one decisive battle, not even through some Hollywood-style final stand. Through math. Empires don't collapse because they get attacked. They collapse because the numbers stop working. And here's the uncomfortable part. Every empire believes the pattern applies to everyone else. Spain believed it was chosen by God. Britain believed it was chosen by history. The Soviet Union believed it was chosen by ideology. Each one thought they had unlocked permanent dominance. Each one believed they were structurally different from anything that came before. They weren't. Let's start with Spanish Empire, the first true global superpower of the modern age. In the 1500s, Spain controlled unimaginable quantities of gold and silver flowing from the Americas. Its currency dominated trade. Its military operated across continents. If you lived in Europe at the time, Spain looked unstoppable. Within a century, it was bankrupt repeatedly. Then came the British Empire. By 1900, it controlled roughly a quarter of the Earth's land surface. The pound sterling was the backbone of global trade. London was the financial center of the world. The phrase "the sun never sets" wasn't exaggeration, it was a logistical reality. 40 years later, the empire was financially broken and strategically dependent on the very nation it once overshadowed. Then there was the Soviet Union. Nuclear weapons, space dominance, massive standing armies, global ideological influence, projected power across continents, and genuinely believed it represented the inevitable future. It disappeared in 1991, not conquered, not invaded, dissolved. 3 different systems, 3 different cultures, 3 different time periods, same pattern. The collapse sequence always begins quietly. At first, nothing looks wrong. The currency still works. The military still functions. Politicians still speak confidently. The headlines still celebrate strength. But beneath the surface, something changes. The empire expands beyond what its economy can sustainably support. Military commitments multiply. Bureaucracies grow. Promises accumulate. Productive industries slowly weaken. And because dominance has lasted for decades, sometimes centuries, nobody believes decline is possible. This is stage 1 of the pattern. Overextension disguised as leadership. Empires convince themselves that global responsibility is proof of superiority, that more bases, more alliances, more commitments equal more strength. In reality, each additional obligation is a liability on the balance sheet. Stage 2 begins when funding that overextension becomes difficult. Raising taxes isn't popular. Cutting spending is political suicide. So governments turn to a quieter tool. They alter the currency. Spain diluted silver with copper. Britain abandoned gold discipline. The Soviet Union printed into irrelevance. Different methods, same objective, stretch purchasing power beyond real productivity. It works for a while. It always works for a while. That's why it's seductive. Stage 3 follows naturally. Debt becomes permanent. Borrowing shifts from temporary emergency measure to structural necessity. Interest compounds. Payments accelerate. The empire starts borrowing to pay interest on previous borrowing. At this point, decline is mathematically embedded but socially invisible. Stage 4 is when productive capacity erodes, when it becomes easier to import than to manufacture, easier to speculate than to build, easier to manage finance than to produce goods. Wealth flows through the empire but doesn't root inside it. Stage 5 brings visible stress, social fragmentation, institutional distrust, political paralysis. Citizens feel something is wrong but can't articulate it clearly. The system feels expensive, bloated, tense. The final two stages, reserve currency, erosion, and sudden collapse, arrive faster than anyone expects. Here's the defining trait of every collapsing empire. They all believed they were different. They all believed their institutions were stronger, their system more advanced, their technology superior, their currency indispensable. History suggests something far colder. The pattern doesn't care about semi-medj, it cares about arithmetic, and arithmetic is undefeated. In the next chapter, we break down the first stage in detail, military and financial overextension, and why it always feels like strength right before it becomes fatal. If collapse begins anywhere, it begins with applause, not panic, not riots applause. Stage 1 of every empire's decline looks like strength, expanding influence, expanding commitments, expanding military reach, more treaties, more bases, more leadership. The empire stands taller than ever, and that height becomes the problem. Take the Spanish Empire. At its peak, Spain was fighting in the Netherlands against the Ottoman Empire in the Mediterranean, clashing with England at sea, managing colonies across the Americas, and projecting power into Asia. On paper, this looked like dominance. In reality, it was a logistical nightmare financed by silver that hadn't even arrived yet. More territory meant more defense. More defense meant more soldiers. More soldiers meant more pay, more ships, more weapons, more supply chains. Every new commitment multiplied the cost of the previous one. And empires don't shrink voluntarily. They expand because expansion feels like proof of greatness. The British Empire faced the same illusion. By 1900, it had garrisons scattered across India, Africa, the Middle East, Asia, and the Pacific. Trade routes had to be protected, colonies had to be administered, naval supremacy had to be maintained everywhere at once. Then World War I arrived. The decision to enter wasn't irrational, it was strategic. But strategy has a price. The war didn't just cost lives, it cost the financial foundation of the empire. Britain shifted from being the world's largest creditor to one of its largest debtors almost overnight. Victory masked vulnerability. That's the trap. Overextension rarely looks reckless in the moment. It looks responsible, necessary, even noble. The Soviet Union offers a modern example. During the Cold War, it matched the United States tank for tank, missile for missile. It funded allies across Eastern Europe, Asia, Africa, and Latin America. It invaded Afghanistan to maintain influence. It subsidized client states to preserve ideological dominance. Its military spending reached unsustainable levels relative to its economic size. But admitting that would have meant admitting weakness. So it continued. That's the psychology of stage 1. Prestige overrides prudence. Every empire begins to confuse presence with strength. The more flags planted across the globe, the more powerful it feels. But each flag represents a recurring expense: salaries, equipment, infrastructure, replacement cycles, long-term obligations. And unlike private businesses, empires don't close unprofitable divisions. Instead, they call them strategic interests. Eventually, military commitments grow faster than the domestic economy that funds them. That's when subtle strain begins. Budgets tighten, equipment ages, recruitment becomes harder. Costs outpace tax revenue. Instead of reducing commitments, leaders search for financial workarounds. That's when stage 2 quietly enters the room. But before we move there, understand something critical. Overextension is not just military. It's bureaucratic, regulatory, financial, political. Empires accumulate obligations internally as well as externally. Pension promises, social guarantees, subsidies, entitlements, all layered on top of global commitments. The empire becomes a web of permanent expenses. As long as economic growth outruns those obligations, everything appears stable. When growth slows even slightly, the math begins to squeeze. And here's the most dangerous part. Stage 1 can last decades, long enough for an entire generation to believe the system is permanently sustainable, long enough for policymakers to treat expansion as the default setting. But history shows a pattern. Spain didn't collapse when it was weak. It collapsed after decades of expansion. Britain didn't fall after losing power. It fell after reaching unprecedented global reach. The Soviet Union didn't disintegrate during retreat. It disintegrated while still armed with thousands of nuclear warheads. Overextension is the silent multiplier. It amplifies every future mistake. Because once commitments are global, failure anywhere becomes expensive everywhere. Stage 1 plants the seeds. Stage 2 funds the illusion. And that's where things start to get creative with money. Once an empire is overstretched, a simple question appears. How do you pay for all of this? Not theoretically, not politically, mathematically. Raising taxes has limits. Citizens complain. Businesses relocate. Growth slows. Cutting commitments signals weaknesses. So leaders search for something quieter, something technical enough that most people won't notice. They adjust the money. Stage 2 of the collapse pattern is currency distortion. It rarely looks dramatic at first. In fact, it's usually framed as reform, modernization, or temporary emergency policy. The Spanish Empire literally reduced the silver content in its coins. The stamps said one thing. The metals said another. At first, the difference was small. Then, it grew. Eventually, trust evaporated. Prices rose. Foreign merchants demanded more real value for the same goods. Spain didn't announce collapse. It engineered inflation. The British Empire followed a more sophisticated version. After World War I drained its gold reserves, Britain attempted to restore the pound to its pre-war gold value. It looked strong on paper. In reality, it overvalued the currency and crushed domestic industry. Exports became too expensive. Unemployment surged. Growth stalled. Eventually, Britain abandoned the gold standard in 1931. The pound fell sharply. The world's reserve currency had just admitted it couldn't maintain its promise. Not collapse, just adjustment. Then there was the Soviet Union. Its ruble wasn't even freely tradable internationally. It functioned domestically by decree. When oil revenues fell in the 1980s, the government printed and controlled prices to maintain stability. Shortages multiplied. Black markets expanded. Citizens trusted dollars more than their own currency. Again, no dramatic invasion. Just erosion of trust. Here's the critical principle. Currency is confidence made visible. When governments expand money supply faster than productive output, they create the illusion of prosperity without the substance. It works temporarily because people measure wealth in nominal terms. Bigger numbers in bank accounts feel reassuring. Asset prices rise. Markets celebrate. Politicians declare success. But underneath, purchasing power weakens. Stage 3 naturally follows the debt spiral. When money is easier to create, borrowing becomes easier to justify. Deficits become routine instead of exceptional. Emergency spending becomes baseline spending. Spain borrowed from European bankers repeatedly, defaulted multiple times, and returned to borrowing again. Each default was framed as restructuring. Each restructuring was presented as stability restored. Britain financed the world wars through massive debt issuance, largely to the United States. By the end of World War II, it owed more than its entire annual economic output. The empire still existed politically, but financially, it was dependent. The Soviet Union relied heavily on energy exports to generate hard currency. When oil prices dropped, it lacked the reserves to maintain both military commitments and domestic stability. Debt and depletion converged. Debt spirals are deceptive because they grow gradually, then suddenly. At first, interest payments are manageable. Then they begin consuming larger portions of government budgets. Eventually, borrowing is required just to service existing debt. At that point, growth must accelerate faster than compounding interest. When it doesn't, options narrow quickly. Cut spending. Politically explosive. Raise taxes. Economically damaging. Print money. Inflationary. Borrow more accelerates the spiral. Every empire convinces itself it can manage this balance indefinitely. That its institutions are sophisticated enough. That its financial markets are deep enough. That its currency is trusted enough. Until one day, lenders demand higher yields, or investors diversify elsewhere, or inflation spikes beyond control. Currency debasement and debt expansion are not signs of immediate collapse. They are coping mechanisms. They buy time. They postpone reckoning. But they also guarantee that when correction comes, it will be more severe. Because debt compounds. Because confidence breaks quickly. Because once a reserve currency shows structural weakness, alternatives begin forming quietly. By the end of stage 3, the empire still looks functional. The military still operates. Markets still trade. Leaders still project confidence. But the foundation has shifted. The system now requires constant expansion just to maintain stability. And constant expansion is impossible. In the next chapter, we move into the phase most citizens finally notice when productive capacity fades and social strain becomes visible, when decline stops being theoretical and starts becoming personal. Up until now, the collapse has been technical: currency adjustments, debt expansion, accounting maneuvers, central bank interventions. Most citizens don't track bond yields or reserve rate. Stage 2 and 3 can unfold quietly behind financial headlines. Stage 4 is different. Stage 4 is when the real economy weakens. This is the moment when an empire slowly forgets how to produce. The Spanish Empire is the clearest historical example. Flooded with silver from the Americas, Spain discovered it was easier to buy goods than to manufacture them. Why build domestic industry when precious metals could purchase textiles from Italy, wine from France, ships from the Dutch? Silver became a shortcut around productivity. Over time, Spanish manufacturing shrank, agriculture stagnated, skilled labor migrated elsewhere. Wealth flowed through Spain, but it didn't stay. The empire became a transit hub for money, rather than a creator of value. When silver production declined, Spain had nothing underneath it. The British Empire experienced a subtler version. As financial services in London expanded, industrial dominance gradually eroded. By the mid-20th century, competitors like the United States and Germany had surpassed Britain in manufacturing output and technological scale. The empire retained prestige, but its productive edge was fading. Prestige doesn't fund itself. The Soviet Union faced an even harsher version. Central planning stifled innovation. Factories produced goods nobody wanted. Technology lagged decades behind Western competitors. By the 1980s, the USSR, a vast landmass with immense natural resources, was importing grain. When a superpower cannot efficiently feed or supply itself, the problem is structural, not temporary. Stage 4 is about dependency. Imports replace domestic production. Supply chains stretch across oceans. Essential goods become externally sourced because it is cheaper or politically easier than rebuilding local capacity. At first, this seems efficient. Globalization lowers costs. Consumers benefit. Corporations increase margins. But resilience declines. When productive capacity shrinks, the economy becomes vulnerable to external shocks. Trade disruptions, commodity price swings, geopolitical tension. Suddenly, the empire depends on foreign stability to maintain domestic normalcy. That's not strength. That's fragility disguised as efficiency. Then comes stage 5, social strain. This is when citizens feel the shift. Opportunities narrow. Upward mobility slows. Wages stagnate relative to living costs. Institutional trust declines. Political polarization intensifies. Public debate becomes hostile and fragmented. In Spain, urban poverty surged as industry declined. In Britain, post-war austerity and currency crises reshaped daily life. In the Soviet Union, shortages became routine. Long lines, empty shelves, quiet frustration. Social decay doesn't mean chaos overnight. It means erosion. Confidence erodes. Faith in leadership erodes. Shared national identity erodes. Crime rises. Productivity falls. Cynicism spreads. Stage 5 is dangerous because it amplifies every previous stage. Debt becomes harder to manage when growth slows. Currency stability weakens when trust weakens. Military commitments feel heavier when domestic morale declines. The empire begins arguing with itself. And here's the pattern's cruel irony. At stage 5, most leaders double down. They increase spending to stimulate growth. They expand regulation to restore control. They print more to cushion instability. They project more power to prove strength. But the underlying issue isn't confidence, it's capacity. If an economy cannot produce sufficient real value, goods, services, innovation, energy, then no financial engineering can permanently compensate. Spain tried to preserve glory. Britain tried to preserve status. The Soviet Union tried to preserve ideology. None addressed the structural imbalance in time. By the end of stage 5, collapse isn't guaranteed tomorrow, but flexibility is gone. The system has limited room to absorb shocks. It becomes brittle. And brittle systems don't decline gracefully. They fracture suddenly. Which brings us to the final 2 stages, the ones that move faster than anyone expects. The loss of reserve currency status, and the moment when arithmetic ends the debate permanently. Empires do not collapse slowly at the end. They'll wobble slowly, then they'll fall quickly. By the time an empire reaches stage 6, The internal weaknesses are already embedded: overextension, currency distortion, debt dependency, declining production, social strain. The structure still stands, but it stands on thinning ice. Stage 6 is the turning point most people underestimate. It's the loss of monetary dominance. For the Spanish Empire, that moment came when European merchants stopped trusting Spanish coinage at face value. Silver content had been diluted too far. Inflation had distorted pricing. Confidence cracked. Trade began adjusting away from Spanish financial reliability. Spain still had territory. It still had armies, but it no longer controlled trust. For the British Empire, this shift happened after World War II. The pound sterling had anchored global trade for generations, but war debts, declining industrial power, and financial exhaustion weakened its credibility. The United States dollar gradually replaced it as the world's primary reserve currency. This was not announced as defeat. It was presented as cooperation, transition, modernization. But when a reserve currency loses dominance, it loses leverage. Reserve currency status allows a nation to borrow cheaply, finance deficits icily, and export inflation outward. When that privilege erodes, the financial math tightens dramatically. Debt becomes more expensive. Imports become costlier. Budget flexibility shrinks. The empire feels the pressure internally. The Soviet Union never had a true global reserve currency, but it depended heavily on energy exports and hard currency inflows. When oil prices dropped in the 1980s, revenue collapsed. Without sufficient foreign currency reserves, it struggled to finance imports, military commitments, and internal subsidies. Once confidence in the system broke, first economically, then politically, events accelerated. Stage 7 is not gradual decline. It is sudden recognition. The moment when markets, citizens, and global partners collectively understand that the empire cannot sustain its promises. Spain's decline stretched across decades, but its bankruptcies came sharply. Britain's imperial unraveling accelerated within a generation. The Soviet Union moved from superpower to dissolution in under 3 years after the fall of the Berlin Wall. No invading army marched into Moscow in 1991. The math simply stopped working. This is the final law of the pattern. Collapse happens when funding commitments becomes mathematically impossible, not difficult, not inconvenient. At that point, governments face impossible trade-offs. Slash spending and risk domestic instability. Print aggressively and risk hyperinflation. Default and destroy credibility. Attempt reform under crisis conditions. Every option carries pain. And because earlier stages were prolonged through delay tactics, debt issuance, monetary expansion, strategic optimism, the final adjustment is compressed. It feels sudden because denial lasted so long. Here's what makes the 7-stage pattern so powerful. It transcends ideology. Monarchies, parliamentary empires, communist states, different systems, identical outcomes. The common variable is economic overreach, combined with monetary distortion. Empires don't fall because they lack strength. They fall because they misuse it. They assume global dominance is permanent. They treat reserve currency status as entitlement. They expand commitments without proportional productive growth. They postpone reform because current conditions still feel manageable, until one day they aren't. History does not announce the exact date of collapse. It signals through stress fractures, rising debt servicing costs, currency volatility, trade realignment, institutional distrust. The final stage is rarely cinematic. It is administrative, financial, contractual, a sequence of broken obligations that cascades into systemic restructuring. Afterward, historians debate causes, politicians debate blame, citizens adjust to a new reality, and the former empire becomes a case study. Spain became a regional European nation. Britain became a respected but secondary power. The Soviet Union became multiple independent states. None vanished culturally, but none retained superpower dominance. The 7-stage pattern is not prophecy. It is precedent. And precedent is stubborn. Empires rise through production, discipline, and innovation. They decline through overextension, distortion, and denial. The question is never whether a pattern exists. The question is whether leaders recognize it early enough to interrupt it. Because once stage 6 begins, stage 7 doesn't wait politely. It accelerates. And arithmetic, as history repeatedly demonstrates, does not negotiate. History doesn't whisper. It repeats. The rise and fall of the Spanish Empire, the British Empire, and the Soviet Union prove one thing: no superpower is immune to economic law. overextension, currency, debasement, debt spirals, industrial decline, and reserve currency erosion aren't random events. They're stages in a pattern. The real question isn't whether collapse can happen, it's whether leaders and citizens recognize the warning signs in time. If this breakdown changed how you see global power, hit subscribe, share this video, and stay ahead of the next shift. Because when empires fall, they don't send invitations, they send shockwaves.